Hi, welcome back to Shake Inside. We have discussed some of the interesting financial ratio in the previous video, link in description. Now we are going to talk about coffee shop and how it manages its money. Are you ready? Great. So imagine there is a coffee shop that sells lot of coffee and makes lot of money. Every year they make 1 crore rupee from selling coffee. But they can't put all this money in their pocket. They also have to spend money to make that coffee. They need milk, sugar and coffee powder and some other direct expenses which cost them 70 lakhs. They also have other indirect expenses like rent and utilities which cost 10 lakhs. So in total they spend 80 lakhs every year. Now let's talk about something called operating performance. It's like a report card that tells us how well the coffee shop is managing everything, or they controlling cost, increasing sales and making a profit. It is important to know to understand if the coffee shop is making good money. So we need to look at something called the gross profit margin. It's like a percentage that tells us how much money they are making from their main business. Let's say they are selling a cup of coffee for 20 rupees. After they subtract the cost of making the coffee, assume it is 14 rupees, they are left with 6 rupees in their pocket. That is the gross profit margin. To calculate the gross profit margin, we use this formula: revenue minus cost of goods sold. Shortly, it also called as COGS, and divided by revenue, and then multiply it by 100. In our example, it would be the revenue is 1 crore and the expenses is 70 lakh, and again divided by 1 crore and then multiply by 100. That equals to 30%. So the coffee shop has a gross profit margin of 30%. That means after they subtract the cost of making the coffee from the money they earned, they keep 30% revenue, 30% of the revenue as profit. But wait, there is more. We also need to look at something called the operating profit margin. It tells us how much profit the coffee shop makes from its main operation, excluding things like taxes and interest expenses. Remember, the 6 rupee they had left, well, they can't keep all because in the pocket, because they have other expenses to pay like rent and other expenses. Let's say those expenses are rupees 2 per cup of coffee. So now they have only 4 rupees left in their pocket. That is the operating profit margin. To calculate the operating profit margin, we use this formula: revenue minus cost of goods sold minus operating expenses divided by revenue and then multiply by 100. In our example, it would be 1 crore total revenue minus 70 lakh expenses COGS minus 10 lakh other expenses divided by 1 crore and then multiply by 100. That equals to 20%. So the coffee shop has an operating profit margin of 20%. That means after they subtract the cost of making the coffee and other operating expenses from the money they earn, they keep 20% of the revenue as profit. That's still good. Based on calculation, the coffee shop is doing a great job managing its cost and making money. It has a gross profit margin of 30% and an operating profit margin of 20%. This shows they are really good at controlling their production cost and managing other expenses. They are making a profit, which is a good thing. Remember though, it is important to look at the other financial indicators and factors to get complete understanding of the coffee shop overall performance. But for now, we can say that the coffee shop is doing well and has the potential to make money, even more money in the future. I hope you enjoyed learning about operating performance. If you found this video helpful, remember to give it a thumbs up and subscribe to my channel for more exciting and informative content on our road to creating young Warren Buffett. If you have any question or comment, feel free to leave them now below. Thanks for watching, and I will see you in the next video.